Today, we're talking about a ticking financial time bomb. Not in the Middle East, not in crypto, but in global debt markets. Japan holds about $1.2 trillion in U.S. Treasury bonds, and shifts in Japan's markets could trigger seismic moves in interest rates, the dollar, and asset prices worldwide. Investors need to understand what's happening right now, or risk getting blindsided. Japan is one of the most indebted major economies on the planet. Its debt-to-GDP ratio sits well above 230 to 250%, far higher than the US, and the government funds that debt mainly by issuing bonds. For decades, the Bank of Japan, BOJ, kept interest rates near zero and bought huge quantities of its own government bonds, suppressing yields and keeping borrowing costs pain-free. That also kept money moving out into the world, including into U.S. Treasuries. But that era is shifting. Long-term Japanese bond yields are rising sharply, which changes the whole financial equation. Japan isn't just another buyer, it's the largest foreign holder of U.S. Treasury debt, with roughly $1.2 trillion on its balance sheet. That stake makes Japan a major player in U.S. borrowing markets. If Japan holds or increases its buying, it helps keep U.S. yields lower. But if they reduce or sell, it puts upward pressure on yields, raising borrowing costs from mortgages to business loans. A key mechanism tying Japan to global markets has been the carry trade. Borrow cheap yen, invest in higher-yielding assets abroad, including U.S. Treasuries, bonds, stocks, and real estate. But as Japanese rates rise, that trade becomes less profitable. When the cost to borrow yen overtakes returns abroad, leveraged investors unwind their positions, meaning forced selling globally. That's why analysts talk about this situation as a global debt system reset, one where liquidity dries up, borrowing costs move higher, and markets get shaky. If Japan stops buying U.S. Treasuries or repatriates capital back home, Treasury demand falls, pushing yields higher to attract other buyers. Higher yields don't just move the 10-year note, they ripple through mortgages, auto loans, corporate debt, and municipal financing. And when yields rise, stocks can struggle because higher safe-rate returns make equities less attractive. There's no single inevitable outcome, but here are the key scenarios. Japan holds steady, yields stabilize, global markets breathe easier. Japan repatriates capital or sells treasuries, yields spike, borrowing costs rise, markets tighten. Carry trade unwinds sharply. Leveraged positions liquidate, triggering volatility. Central banks, including the Federal Reserve, will watch these signs closely because they affect policy decisions on rates and liquidity. Investors who worry about a macro reset often talk about diversification beyond U.S. debt, such as allocation to precious metals like gold or silver, inflation-protected instruments, or uncorrelated assets. That doesn't mean every investor should abandon U.S. bonds. It means understanding that all markets are connected and that Japan's policy moves have ripple effects far beyond Tokyo. Here's the bottom line. Japan's $1.2 trillion stake in U.S. Treasuries isn't just a number, it's a macro risk lever. As yields move and monetary policy shifts, that lever could tighten or loosen global liquidity, influencing the U.S. economy, markets, and investment returns. Stay tuned. Because this story isn't just about Japan, it's about global financial equilibrium.